Hello everyone, my name is Norbert Kiiza and you're most welcome to FX Pesa's YouTube channel. If you're here and you're a new trader, this video is for you because today we are going to be focusing on smart trading tips for novice traders. Trading, of course, is a new thing for most of us, but it's something that is not really hard to learn. I believe if you want to venture into trading, you need to be someone who is willing to learn, and you need to be someone who is also relatively good with a few numbers, because trading is also about calculating your risk and making sure that you're within it. So some of the trading tips we're going to go through. The first one is going to be risk management. When you talk about risk management, we are focusing on how can we ensure that whenever we are trading, we stay in the game of trading. The moment you don't manage risk, then you just know that your trading journey will not be long, because risk management is what will keep us having our trading account, and also risk management is what will also enable us to grow with our trading. When it comes to risk management, we are focusing on aspects of how do we calculate how much we are willing to lose, so that at least if we lose that amount, it does not affect the overall account. There are many ways and many things we can do to manage risk. The first one is using pending orders such as stop orders. Now, pending orders are orders which you set in on your trading account that made in such a way that they are to be executed later. That is why they are called pending. So pending orders work in a way that sometimes when we go on our charts to trade, you'll find that maybe the market is not at an optimal price that you'd have wished it at. For example, you're trading gold and you want to sell gold at 2,440 because that has been the highest level that gold has visited in the past 2 weeks. Now, when you go to the market and you find that gold is actually trading at 2,420, but it is showing bullish signs, it is showing that it's going to move higher, what you do in this case is that you will set a pending order. Because if gold goes to a level higher than its current price, you want that it triggers that level and gets you in at the highest price possible. So you will set a pending order. In this case, the pending order you set is a sell stop. A sell stop is a pending order that you set above the market price, so that in case the market gets to that price, it will trigger that level and possibly move lower. Now, that is what we call a pending limit order, because we are expecting the market to move higher, trigger the sell limit and sell. Now, say for instance, gold is trading at $2,400 and you're uncertain of whether gold is going to keep buying, okay? Now, what you do in this case is that you will set what we call buy stop, okay? A buy stop ideally is set above, so that in case the market actually buys, it's going to come and trigger that level and move even higher. The stop orders, as we know them, or limit orders as we know them, are usually used during news trading. The reason why we use them during news trading is because during news, for most traders, we're uncertain of what's going to happen. We're uncertain of whether the market is going to buy or the market is going to sell. So when you set a stop order or a limit order, you're ideally protecting yourself, or you're ideally anticipating the market is going to do one of two things. And how the pending order will help you is that in case the market buys, you're going to make money. And in case the market sells, you will make money. The second one is using stop losses. Setting stop losses on every trade to limit account drawdown. Now, Forex trading is not meant to be a business that can make you broke or a business that can make you lose all your money. If it were the case, then we would not have a stop loss. A stop loss is there on FX Pesa's trading platforms, and it is there for a reason, which is to limit account drawdown. When you talk about account drawdown, we're talking about limiting how much the account goes into a loss, okay? So if I deposit $100 and I want to make sure that as I try to look for good trading opportunities for me to grow my $100 to say $500, I'm going to be using a stop loss. The stop loss is going to enable the account to thrive in times of losses, and it will also help the account not to get depleted completely. So it is important that as a new trader, you ensure that you set stop losses whenever you're trading. The third one is limiting trading periods to high probability periods. Now, this one is very, very important when it comes to risk management, because the more we are in a market, the more we are bound to lose money. The market is not designed for you to be in it the whole day or the whole month. Sometimes you may find an entire month happens maybe when it's not a good period for you and for what you trade. So either you can move to another asset, or you can maybe give it a rest and you wait for when the opportunity is there. What is important when it comes to limiting trading periods? The question that you have on your mind is, when is the best time to trade? The best time to trade is typically during session opens. When it comes to sessions, there are various sessions. The first one being the Asia session. So when we look at the Asia session, we first start with the Sydney session, which opens at about 1 a.m. And I know that if you're in East Africa, most likely you're not trading the Asia session. That covers the countries of Sydney, which is in Australia, and then also, of course, we have Tokyo, which is in Japan, and then we moved other financial centers such as Shanghai. All that we cover the Asia. But Asia, we find that one is very early in the morning, and it's not usually convenient for us because at that time is when most of us are asleep. So you'll find that the two best trading sessions are typically the London session, which is usually when we are awake, that is at around 9 a.m. And then, of course, we have the US session or the New York session, which opens at about 4:30 p.m. Now, these sessions are very key when it comes to trading certain assets, such as if you are trading GBP/USD, maybe Euro/USD, that's for the London session. And when it comes to the US session, you're focusing on the US indices. You're also focusing on assets like gold, which also tends to do well sometimes during the London session. But you'll find that gold normally has some really good setups and trading opportunities from 1 hour before the US session, around 3:30 p.m. and all the way towards about 8 p.m. So picking particular period to trade is very, very important because it will align with your trading strategy, and it will also allow you to be able to make money. The fourth one is track your trading progress, making sure to see or identify weak spots and trading strengths. Now, when you have a trading journal in your trading plan is going to be very, very important, because journaling your mistakes are going to allow you to be able to identify your weak spots. When, say for instance, you had a trading, say maybe you are trading something like GBP/USD, and for that time when you are trading GBP/USD, you are up about $500, but then because you did not take your profit, the market pulled back a bit, and maybe you did not have a trading stop, which would allow that maybe if you're up, say, 500, or you're up maybe, say, 50 pips, and your trading stop is trailing by maybe 5 pips, it pulls back by 5 pips, you close your trade with 45 pips. Now, if you do not have a trading stop, or if you do not, or say, for instance, for that time when you are trading, the market pulled back too much, no trading stop, you did not move your stop loss into profit, and then you find yourself down by so much. Now there you'll know that I was at an opportunity for me to make $500, but instead I made $50. And the issue with that is I simply did not move my stop loss into profit, or I simply did not trail my stop, or I simply did not even have a take profit. Some people don't have take profits, you know? So you'll always find that if you note down that mistake, then it will allow you to trade better next time. Sometimes it could also be when it comes to lot sizes. Your trading plan should have a lot size you're supposed to be using. Some people use very big lot sizes for their accounts, and within a day the account is gone because of a lot size you are using. If you find yourself changing lot size too often, then just know that you're not doing the right thing, because you will reach a time where the market will finish your account because of how many pips your account moved by. So your lot size should stay the same, and it should not affect your trading account. You should only see yourself changing lot size when your capital has grown even more, and therefore you should also be able to take a bigger lot size. Now when it comes to lot sizes also depends on your capability emotionally. Some people are able to trade bigger lot sizes simply because they have gotten to that point mentally where they can manage that size of loss or that size of profit that is within their risk parameter. Some of us will not be able to manage it simply because we are not yet at that level mentally for us to be able to manage certain amounts. And therefore, we have to take time. So you don't rush the process, take your time and see how that moves. Now, the third one is practice, practice, practice. Practicing is very, very important, and that is why we have a demo account for that reason. The demo account is purely a testing environment for you to test your skills, test your strategy, and use that when you're doing your trading. When it comes to testing your skills, you're testing maybe when it comes to testing scalping, or maybe you are testing swing trading, or maybe you are testing whatever strategy it could be. Do that on your demo account, see how it works, and then once you have perfected that, then you can now move to a live account and you can trade on the live account. Live trading but testing out strategies on a demo works well to discover what works and what doesn't. Simply because it's a live testing environment, it will give you the opportunity to try out numerous strategies that you think can complement your trading strategy. Now, the moment you've been able to identify it, then now you can go and practice that, or now you can go and actually do it live on a live trading account. When it comes to trading accounts, it's also important to understand that your trading account should complement your trading strategy. If you are a scalper, you should not be using an FXPesa standard account, simply because scalpers shouldn't have an issue with spread. The moment your spread is too much and you're a scalper, you're not going to make money with scalping because the spreads are very big. When you look at the FXPesa Premier account, it has close to zero spreads, which means that if you open up a trade, your trade is going to go into profit almost immediately. And that is a good thing with scalping because scalpers want to make quick profit in a short period of time. If you're a scalper and you're using a standard account, you need to switch over to the FXPesa Premier account so that you can make money. Fourth one, and which is the most important, is keep your emotions in check. Your emotions are very, very important, and you have to make sure that you do not involve your emotions when it comes to trading. Don't get too excited. Don't get too sad. When it comes to trading, you stay emotionless, because when you mix emotions with trading, you're going to find yourself making a lot of errors. First one is you stay patient. Trading strategies, trading setups rather, take time to form. Sometimes they can take days, they take hours, but when the setup has showed itself, then it's an opportunity for you to actually take the setup and make money with that setup. Do not rush the market, do not rush a setup, don't take a trade when there's no setup, because that is not trading, that is purely gambling. You trade when there's a setup. Second one we are saying is, remember, the market determines our profit. All we can determine is our risk exposure. Certain things are beyond our control, such as the outcome of the trade. That is beyond our control. You can't control whether a trade is going to be in a profit or loss. However, trade setups are classified into various types. You have a trade setup which is an A+ setup. This one is a setup that has appeared numerous times. It's a setup whereby we are seeing a trading pattern. It could be maybe a trading pattern such as maybe a bearish flag. A bearish flag appears many times. Whenever it appears, the market always sells. We have, say, maybe 2 bullish pin bars, okay? Or even 3 bullish pin bars. And we are seeing a nice liquidity sweep. Whenever we see that setup, is a sign for us to buy. You are seeing maybe a double top, okay? It could be a triple bottom. All these are A+ setups for us to trade. So the more A+ setups you have, then the more your opportunities for you to actually trade. The less you have, then the less you should actually be just observing and not really doing any trading. Now, that takes me to the third one, which is avoiding stalking markets. Stalking markets or stalking your charts is something that is a vice that many traders actually have. And it's important. You should never ever stalk your charts. The moment there is nothing on the charts, you should not actually be on your charts. You should be doing other activities. If you have work to do, you do the work. If maybe you have another activity, go and do that activity, but not sit on the charts. Staying on the charts will open you up to doing erroneous trades that you shouldn't even be doing, and which of course will eat into your trading capital. Now, the fourth one is trading decisions should not be emotion based, but rather based on the trading strategy. The moment you open up any trades that are not based on a trading strategy, this simply means that you're opening yourself up to losses. And the issue with that is that you're most likely to make losses. It's very, very important that you check your emotions and you keep them in check whenever you're doing trading. That sums up our smart trading tips for novice traders. If you've liked this video, kindly subscribe. If you want to learn more about trading, watch this video here for more information. Cheers.